Interest rates on this loan are not fixed. This is the paradigm shift. There are three things that matter when you borrow money. Only three. At the end of the day, there's three things that equate into the cost of the debt itself. And by the way, it's the same three variables at play when you invest money and you hope to grow the value of that money or the value of that asset. The same three variables. There's only three: interest rate, the term or time, and then the principal balance, right? If you're trying to grow money, we're all taught, invest, pay yourself first, invest with as much as you possibly can that you can afford, as frequently as you can do that, for as long as you can do that. Start early in your life. Start investing, building up your savings, building up, whatever your retirement funds. Start investing sooner, right? So we're taught that time matters and that your principal balance matters. What we do also know about investing money is that the market ebbs and flows. It rises and falls, right? So your yields are going to change over time. But what matters most is the amount of time you stay, committed to investing, as well as building up your principal balance. Conversely, think about managing debt. It's the exact same scenario, just kind of on its head. What matters most isn't the interest rate. What actually matters most is the amount of time you're in debt for and what you're doing with your principal balance. Again, are you dropping it fast, or is it going to stay high for a long time? If that's the case, even with your low interest rate mortgage, it's going to cost an arm and a leg in interest cost. You can have a significantly higher interest rate loan and pay significantly less interest and spend less time in debt. We chose not to create a fixed amortized mortgage instrument out of this product. Instead, what we chose to do is create a rate structure that is aligned with our own borrowing structure. When banks and lenders borrow money, they're not at fixed rates. They fluctuate over time with the market cycles. What we said is we set out to make a product that allows our customer to really, share that risk and the benefits of rates moving up or down. We do offer a 5-year fixed version. After the 5 years, it becomes a monthly adjustable. We also offer a 3-year fixed option. After the 3 years, it goes into a monthly adjustable. Or we offer just the straight monthly adjustable, 1 month adjustable. So we're not locking in the rate, locking in the payment. And I'll show you the payment structure of this loan here in just a moment. It's very unique, very appealing, much better. If you think about it, what good is a fixed rate and a fixed payment as the cost of living is increasing? As the cost of living increases with inflation, that means there's less and less and less residual money left over each month. So you're being squeezed. Every household in America out there is being squeezed because the price of gas is up, real estate is up. The price for a pound of coffee is up nearly 50% over the last 20 years. I mean, everything around us is rising in cost. So if you have a payment on your mortgage that's fixed over 30 years, you're still being squeezed. What's great about this loan is it provides an opportunity to reduce the amount of mortgage interest or the mortgage costs that a customer has to pay each and every single month. And in fact, reduce it at a faster pace than money is eroding away due to inflation. So it's a phenomenal product to use as a hedge against inflationary pressures and the expense of inflation, but also just simply to live a lot more independently, financially speaking. Most of our customers choose the 1 month option. It's a monthly floater, can move around. The index that we use is called the 1 year constant maturity treasury rate, or the CMT, AKA the 1 year treasury. Its historic average is right around 2%. So very low. That's why we chose it. It's very predictable. Rates are very competitive to conventional mortgages. So just keep that in mind. It's a competitive rate. The interest rate can fluctuate, but due to its entire design, your balance drops significantly faster. That's the opportunity. The key feature on the loan is, and the reason we brand it the all-in-one loan, is because it also comes with a consolidated bank account, a checking account. In other words, we have merged together home financing and personal banking into one instrument, one financial product. And if you really think about it, this makes a tremendous amount of sense. A lot of money flows through your personal checking account. Most Americans will earn more in just 5 years than they owe on their mortgage. And those dollars all typically flow through a primary checking account, right? It's a landing place for money. It securely sits there waiting to be spent, earning near 0%. And then we pay our bills slowly out of that, including a traditional mortgage payment, in which is costing us much higher interest, much higher in interest rate, and much higher volume of interest is being charged on our debts than we're being paid on our money. But there's this invisible barrier between the two, right? Between our cash accounts, where we manage our finances from, and our debts, our liabilities. What we said is, gosh, let's break down the barrier. There shouldn't be a barrier. Let's link them together. Let's link the checking account to the mortgage. And let's make the mortgage a two-way instrument, freely allowing people to put money in and take money out whenever they want. But let's make the mortgage the temporary holding place for the cash. And the way people get money into the mortgage is through the checking account, the linked checking account. So it's also known as a zero balance sweep checking account. And now what this means is, if you were to make a deposit into your all-in-one loan checking account that comes with your mortgage, either through a purchase or refinance, your money doesn't reside there. Instead, it's going to sweep and automatically pay down the principal balance of the mortgage. If you deposit $1 today into your all-in-one loan checking account, your principal balance drives down by $1 today. If you put your paycheck into your all-in-one loan checking account, your entire paycheck sweeps that day securely to the mortgage side and pays down the balance of the HELOC. And that's an enormous benefit. Number one, because money's kept liquid and available to use 24/7 through all the banking features. Comes with ATM debit Visa cards, online banking, bill pay, mobile banking. You could do mobile deposits through the mobile app. You could link external accounts to the all-in-one loan checking account, transfer money in and out without fees. You could wire money anywhere. You can use this globally. It's a highly secured, FDIC insured checking account, serviced by one of our great bank partners across the United States. But again, the mortgage is meant to be the holding place for your money. And that's a benefit because of the way interest is computed, and because of the amount of time that money tends to loiter around before it's spent. If you think about how we spend money as consumers, we don't spend, all of our money that we need, on one day for the month. You don't buy all your groceries for the month of May on May 1st. That's a weekly expenditure. We also have one-time expenditures like a utility bill or a cell phone bill. The mortgage, the traditional mortgage payment, is a one-time a month payment, right? So money kind of resides in your accounts waiting to be spent, earning 0%. Quarterly expenses, semi-annual expenses, and some annual expenses like income taxes. As money's waiting to be spent on these things or not spent at all, instead of leaving cash in a cash account where it's losing buying power due to inflation and earning 0% or near 0%, the average rate of return for a checking account in the United States today is a mere 0.03%, 0.03%. But again, people will earn and manage more money in their checking account in just 5 years than they owe on their mortgage. Bolting these two together makes a lot of sense. It's very practical, very easy.